Welcome to the Deep Dive. Our mission today, we're going to unpack a market event that was, well, as sudden as it was vicious. You handed us a stack of sources detailing this massive single-session plunge, all triggered by geopolitics. Our goal is to give you a shortcut, really, to understanding the complex chain of cause and effect here. Specifically, we need to get our heads around this paradox. Why did a trade tariff, something usually hitting physical goods, absolutely gut the valuation of companies trading on AI and, future software growth?
Yeah, we're drilling down into what the analysts are calling the tariff shock and tech sell-off market analysis. It's quite something. This report gives us a fascinating, almost real-time look at how quickly a policy decision can just shatter expectations. It's a classic volatility event, really, and we have the metrics to show precisely where that fear settled in.
Okay, let's unpack this then, because, when the Nasdaq sheds over 3% in a single day, that's not just a correction. That feels much more like fear-driven liquidation. It wasn't a tremor. It was an immediate shock to the whole system. So let's start right there with the specific catalyst. What piece of news actually triggered this violent move, and how quickly did the market react?
The catalyst was a really swift escalation in the trade war narrative.
Okay.
It came down to renewed threats from President Trump. We're talking about imposing truly massive tariffs, specifically 100% on Chinese goods.
100%. Wow.
Exactly. And this threat wasn't just arbitrary. The sources confirm it was a direct response to China using export controls on critical minerals. So that immediately signaled a potential structural change in the cost of doing business globally.
And the market response was just pure rejection, wasn't it? We should probably ground the scale of this shock for you, the listener.
Oh, the reaction was visceral
Mm-hmm.
and immediate. U.S. stocks saw a really steep drop. The broad S&P 500 fell, what was it, about 2.7%. But the real pain, the epicenter, was the growth sector. The Nasdaq dropped closer to 3.5%. And to put that into perspective, that level of single-day sell-off wipes billions, literally billions, off balance sheets. It signals institutional panic. It forces mandatory liquidation for a lot of leveraged traders out there.
Okay, now this is the core of it, right? Why did the technology and AI sector bear the absolute brunt of this move? When we talk tariffs, historically we think manufacturing, maybe agriculture. Why are names like Oracle, NVIDIA, Tesla, the ones the analysis highlighted, why are they so sensitive to tariffs on critical minerals?
They're sensitive because their whole futuristic promise, everything they're built on, relies on very physical, very immediate inputs. This isn't just about, say, the final assembly of a consumer product like a Tesla car. It's about the underlying high-performance infrastructure, the stuff that enables AI, computing, cloud services, all of that.
Tell us more about that physical connection. How direct is it?
It connects through a heavy dependency on specialized hardware. Think about what goes into data centers. You've got specialized high-performance GPUs, sophisticated cooling systems, server racks, complex network hardware. All of these systems rely heavily on critical materials. Things like rare earth elements, specialized magnets, high-purity metals.
Right, stuff that's hard to get or substitute easily.
Exactly. So when China imposes export controls on those, or when the U.S. threatens a 100% tariff on goods that incorporate these inputs, well, the cost structure for building out the next generation of AI capacity, it just instantly becomes volatile, uncertain.
So the tariff threat doesn't just hit today's profit margin on a finished product. It messes with the cost of the massive capital expenditure needed for future growth. Is that it?
Precisely.
That puts enormous pressure on those valuations then.
That's exactly why the tech sector, and specifically AI names, got hit the hardest. These companies, many of them, have been trading at extremely high multiples. Valuations based entirely on the promise of massive, uninterrupted growth and high, stable margins way down the line.
Okay.
A tariff shock like this fundamentally changes the economics of that future capex. It threatens to squeeze margins through inflated input costs, supply chain delays. It really tests the very sustainability of those projected growth rates that everyone was banking on.
And when those growth expectations get challenged by such a clear macro shock, it forces everyone to just reevaluate the risk involved. What specific risks are investors suddenly focusing on now that this structure feels under threat?
Yeah, the focus shifts pretty quickly to three major elements. You've got margin risk, obviously, valuation stretch where these stocks too expensive anyway, and execution risk.
Execution risk. Tell me more about that in this context.
Execution risk here is critical. It means a couple of things, really. First, the risk that the massive capital needed for building out data centers, all that infrastructure to beat AI demand, it's going to cost significantly more or take significantly longer because of this trade friction. And second, there's the potential that Actually, acquiring the next generation of specialized hardware, which often comes from a very limited number of sources, could be delayed or maybe even impossible in some cases.
Hmm. It's easy to forget how visceral these drops feel when you just see the numbers flash by. We're talking about massive uncertainty being priced in basically overnight in a single trading session. But when the market flips into deep risk-off mode, like this, capital doesn't just vanish, right? It simply changes address. So where did the institutional money run to hide?
It was a pretty classic flight to safety, specifically seeking assets that seemed detached from this geopolitical trade friction. Money poured into fixed income. That caused bond yields to decline sharply. We saw the benchmark 10-year Treasury yield drop quite noticeably, moving down towards that 4.06% mark. And meanwhile, gold, the perennial safe haven, saw renewed strength. It was hovering near recent high levels.
That rates dynamic is technically quite crucial, isn't it? Especially for those high multiple growth stocks we were just talking about. For our listener who understands the basics here, how does that yield drop technically cushion the blow for stocks, even while panic is raging?
Yeah, it's a bit counterintuitive, but the mechanics are rooted in the discounted cash flow model, the DCF. When the 10-year yield, which often acts as the proxy for the risk-free rate in these models, drops, it significantly lowers the discount rate you apply to future cash flows.
Right.
In high multiple growth stocks, their valuation is heavily weighted towards earnings projected, say, 5, 10 years out.
Yeah.
So suddenly the net present value, the NPV, of those distant cash flows actually increases. This provides a kind of temporary technical cushion for their valuations. Ironically, it mitigates some of the loss, even while the fundamental risk, the margin compression threat, was actually increasing.
That's a great point about the sort of irony in that market move. Okay, so we've painted a picture of, well, widespread panic and reaction. But let's make sure we provide some balance here. The analysis you looked at shows analysts weren't universally pessimistic, were they?
That's absolutely right. There is a counter-narrative. It's built mostly on the idea that current demand is just incredibly strong, almost inelastic. Our sources mention, for instance, Goldman's Ashok Varadhan. He stressed that the recent rally leading up to this was, quote, fairly high quality. And he argued that for those looking past the immediate trade skirmish, genuine opportunities still exist.
Okay.
The bullish case really hinges on the idea that the underlying demand for AI, for cloud services, is just so powerful right now that these companies actually have significant pricing power.
But that raises an immediate challenge, doesn't it? If demand is so strong and the rally was high quality, why did the market just assume companies like Nvidia or Tesla could simply pass those huge under % tariff costs onto their customers? What gives?
Well, because the market likely doesn't believe in truly unlimited pricing power, especially when the core issue involves global competition and capital intensity. It's not just about the cost of goods sold today. It's about that future investment. The moment a company even signals they might have to delay, say, a $10 billion data center build-out because the specialized hardware components are now delayed or suddenly twice the cost, that hits the growth trajectory assumption, which then immediately hits the valuation multiple.
Makes sense.
So analysts are still really zeroing in on those specific risks we mentioned. The inevitable margin compression, whether valuations were already stretched too thin before the shock hit, and that overarching execution risk tied to deploying capital effectively.
Okay. This deep dive, as always, aims to give you, our listener, some actionable knowledge. So let's transition to the forward-looking indicators. Now that the dust has maybe settled just a little bit, what are the key inflection points we should be monitoring in the coming days, drawing directly from the analysis you reviewed?
Yeah, there are several critical, technical, and fundamental indicators to watch closely. First, we absolutely must monitor the support zones. Can the S&P 500 and maybe more crucially the NASDAQ hold near their prior technical support levels?
Why is that so key?
Because if those levels break decisively, it often triggers algorithmic selling, more technical selling. It basically signals more sustained downside momentum could be coming.
Got it. What's next?
Next, keep a very close eye on yield movement. We talk about that temporary cushion lower yields provided. If Treasury yields suddenly reverse course and start climbing back up toward pre-shock levels, well, that cushion disappears instantly. Growth stocks will feel immense pressure again.
Okay, so support levels, yield movement. What else?
The third is purely political. Tariff tension developments,
Right.
any official signal of de-escalation, maybe high-level talks are announced, or perhaps there's an indication of a retraction of that 100% threat. That could trigger a swift, sharp rebound across the board, just given how much raw fear was priced in so quickly.
Right, the flip side of the panic.
Exactly. Fourth, Focus intensely on earnings and guidance as they come out. This kind of environment will magnify any fundamental weakness. A miss on future guidance from a major tech or AI player, even a seemingly minor one, could be seen as confirmation that this tariff shock is fundamentally impacting future capital plans and margins.
So guidance is key. Anything else?
And finally, watch volume and momentum indicators.
Mm.
We need to look for signs of potential capitulation. That might look like a sharp, dramatic spike in trading volume on a down day, suggesting sellers have maybe exhausted themselves. That kind of reversal spike often signals a floor might be forming, at least temporarily.
Okay, this deep dive really illuminates, I think, how quickly geopolitics can just slice right through valuations that were built on this anticipated smooth path of globalized growth. It forces us to simplify the narrative, maybe. No tech company, no matter how advanced, is truly immune from the physical supply chain anymore. So what does this all mean for the bigger picture? Wrapping up.
Well, it really underscores the critical, immediate, and structural link between trade policy, these incredibly complex global supply chains, and overall market stability, especially in those high multiple, high capex sectors like technology. The narrative that high-growth tech is somehow decoupled from hardware just because it sells software, that's been decisively challenged here by the clear dependency on inputs like critical minerals and the sheer expense of building out AI infrastructure.
A stark reminder. Thank you for guiding us through this fascinating analysis of cause and effect in real-time volatility.
My pleasure. And here's a final provocative thought for you, the listener, to consider. High multiples, as we've said, rely on assumptions of uninterrupted growth and consistently high margins. But this tariff shock just injected massive uncertainty into the cost of future capital investment. So this raises a really important question. In an era where geopolitical tension seems to be escalating and supply chain risks are increasingly being, weaponized, should investors fundamentally adjust how they calculate the risk premium associated with those anticipated high-growth earnings? Is volatility like this inherently the new, necessary price of admission for global technology leadership? Something to think about.